Kia ora, welcome to Shared Lunch, brought to you by Sharesies with Business Desk. Sharesies is a wealth development platform whose purpose is to create financial empowerment for everyone. My name is Dan Brunskill, I'm the markets reporter at Business Desk. Before we get started, we have a little disclaimer from Sharesies.
Investing involves risk. You might lose the money you start with. We recommend talking to a licensed financial advisor. We also recommend reading product disclosure documents before deciding to invest. Everything you're about to see and hear is current at the time of recording.
Today, we're joined by Jason Boyes, who is the CEO of Infratil. Welcome, Jason.
Kia ora, everyone. Hi, Dan.
It's very, very, very good to have you on. You told us you were in Melbourne. Is it possible you're out there looking for investment opportunities? What are you doing in Melbourne?
In Melbourne, no, we're seeing investors because we just released our half-year results. So we were in Auckland yesterday, Melbourne today, and Sydney tomorrow. But actually, we are starting up a business based here in Melbourne. I can talk about that a little bit later if you like.
Yeah, I'm keen to get into that. Let's start with your half-year result. You're a slightly unusual company because it's sort of an investment company. It's about building an investment portfolio and long-term capital returns, but you do have earnings. Tell us about your earnings. Were they good?
The earnings were pretty robust overall, actually, given it's pretty hectic out there with inflation and shortage of staff. Because we are a range of businesses, you get some ups and downs across the portfolio. That's how it's supposed to work, by being a bit diversified. So I think the summary was Vodafone was performing really strongly. Wellington Airport performed above expectations. And CDC has a pretty on-track high growth path. But the diagnostic imaging businesses that we've acquired, they're still stressed and dealing with the kind of tail end of COVID like lots of health businesses are. So, so to get these ups and downs, overall, I think I saw a note this morning, we're sort of 5 or 10% of where people expected us to be. So people are pretty happy.
Yeah. Okay. You've just listed off lots of different types of businesses there. Can you for a new listener, can you help us understand a little bit what Infratil actually is? Because it's not exactly your regular company, is it? What is Infratil?
No. Yeah, it is a bit different. So we are a company. We've actually been listed for 28 years. We were established a long time ago in New Zealand by New Zealanders, but it's a company that doesn't actually have any staff of its own. What it does is it employs another company, Morrison & Co., which is who I work for, to provide all the kind of management capability for Infratil. And the idea of Infratil is to use that capability and the capital that's provided by people on this call and other investors to invest in broadly infrastructure or infrastructure-like assets. So that's what we do. We sort of hold investments that we choose within the company itself. We don't run businesses ourselves.
Yeah. So it's almost like a portfolio of assets which is managed externally and you can buy a stake of. Yeah. Okay, cool. And then what do you consider to be infrastructure? Because I personally wouldn't have thought of, diagnostics, radiology. That doesn't strike me as being infrastructure at first look.
Yeah, and I think we definitely have a track record of anticipating earlier than other investors what could be infrastructure. The things we look for are not necessarily real hard assets like Wellington Airport, which we do happen to own, which is sort of clearly infrastructure. Why are those things infrastructure? Why is the physical asset make that infrastructure? Actually, what's really going on is that it provides a sort of service that everybody needs, and either only it can provide or there are significant barriers to other people coming in and providing that service. So we call those sorts of features defensive cash flow. So it's hard for people to come in and enter the market and either compete away your customers or reduce margins. So we're mainly looking for assets that have those defensive characteristics. If they come with a hard asset like the airport, all well and good, that's probably traditional infrastructure. But in the future, there will be services that will be just as essential. People will always want to buy them, and also have other features that make it hard for people to come in and compete and reduce your margins, so they'll be defensive as well. And that's where diagnostic imaging fits in. It's more an essential service. It's definitely on the edge of what people would have traditionally understood as infrastructure. But when we look globally at what other infrastructure investors are doing, they're continuing to extend beyond hard assets into essential services like that.
Yeah. Okay, that's interesting. And the theme of today's chat is investing in things that matter. One thing that Infratil's invested a lot in is renewable energy. How much of your portfolio is sort of energy or renewable energy related?
It's about a quarter at the moment, so a couple of $1 billion, a pretty significant allocation.
Yeah, and that's something you're looking at expanding?
Yeah, definitely. It's a high growth area. We've been investing in renewable energy for most of our history, so we've got a long set of experience. What we decided a few years ago is that just investing in New Zealand or Australia, you are quite exposed to the regulatory regime in those markets being conducive to developing more renewable energy. So we decided to spread out essentially around the world. We started a business in the US, Europe, and last year in Asia to do renewable development across a bunch of different markets. And the idea there is if one market it's hard to develop in, Australia, for example, is very hard. Somewhere else in the world, it'll be conducive. In the US, particularly with that new legislation that the Biden regime got through, the Inflation Reduction Act's incredibly conducive, and so that can offset difficulties elsewhere in the world.
Yep. The Inflation Reduction Act is an interesting act because it's called the Inflation Reduction Act, but it's really a green energy construction bill. But that's good for you, no doubt.
Yeah, really, really good. So that business, we call it Long Road Energy, that we established 6 years ago with sort of seed capital of about $100 million US on the Infratil side, was valued at about $2 billion earlier this year when we brought in a new investor. And then after we did that transaction, the Inflation Reduction Act was passed, which has really supercharged the whole industry there and meant that people are, I think in terms of our plan, we're sort of 6 or 12 months ahead of where we expected to be before that legislation came into effect. So a real acceleration of the industry we're seeing.
Yeah. It's interesting to hear you talk about wanting to invest in clean energy in multiple different markets to avoid regulatory risk. It's been a while since you've made a sort of clean energy investment in New Zealand. And in fact, you've been rejigging that portfolio. Are you still looking at New Zealand opportunities? Would you make a New Zealand energy investment, or is that not really on the radar at the moment?
Yeah, no, we are looking here in New Zealand. And that's mainly through our business called Manawa Energy now. They are building a pipeline of development projects, but we're waiting to see if the economics of developing here are anywhere near as attractive as the other places around the world where we could develop. So we'll see that pipeline grow, and I expect there'll be 1 or 2 significant projects at the very least that will come out of that will mean significant investment in renewable energy here in New Zealand.
Yeah.
So over the next 4 or 5 years.
Yeah. Looking to see if it's more attractive. So the places you currently run renewable energy platforms is the States, Europe, and you've just set up something in China, not in China, sorry, in Asia. Talk about that. What's the, because we hear a lot about renewable energy in Europe and in the States. What's the state of play in Asia? How much renewable is there now, and how much future opportunity is there?
There has been significant build there. It's quite hard. I mean, Asia, it's very hard to generalize. We're focused outside China at the moment. China is really suited for Chinese developers. So we're sort of Southeast Asia and North Asia and thinking about within that India. There is a big transition to happen. There's still a lot of coal in the system. They can be tougher places to develop in terms of the regimes around land and planning are very variable. But there's kind of a double tailwind in Asia that we don't have elsewhere in the world. One, obviously, they have to decarbonise and are committing to it, so that's a good tailwind for developers. The other is there's still actually quite a reasonable amount of electrification to happen in parts of Asia, places who do not have consistent power. That's clearly not present in the US and Europe, but it's sort of the other tailwind that we don't have elsewhere. So when we think about Asia, we're thinking about diversifying the drivers of our renewable energy business away from just decarbonisation. I mean, now there's a security overlay in the West, but towards something that could pick up the slack if that decarbonisation agenda tails off anywhere else in the world at any time.
Mm-hmm. It's interesting you flagged the geopolitical overlay in Europe. What has that been like? The whole Russia invasion has changed the whole energy landscape in Europe. What has that meant for your businesses, and how have you been thinking about that?
Yeah, I mean, I think we're pretty glad we entered that market 3 years ago with the platform we're building there, Galileo, it is called, based in Milan. It means that starting a business now would be way more expensive than before, because there are a lot of people. The value of the projects that are available now has increased a lot, and the demand for them has increased a lot, because for energy security reasons now, power needs to be bought that's not reliant on imported energy, particularly gas from Russia. So it's quite a big shot in the arm. The kind of headwind that comes with it, though, is that everybody's looking to develop at the same time. So your input costs, the cost of panels, labour, all those sorts of things is going up at the same time. So the way we deal with that is you need the power price. It's the only thing that can really adjust to offset some of those increases and help you sort of maintain your margins. I think net, we should see margins remain stable, but maybe cadence, the amount of projects you're pushing out, increase is what I would expect.
Okay, right. So there's a lot of demand for what you're doing, but the cost of doing it is also going up.
Yeah, it all happens at the same time, yeah. So there's no free hit often in these places. But I think if you can get to a place where you end up developing more projects faster, then obviously that's a good thing in terms of the decarbonisation, but also it means that profit that you're making per project, you're just doing that more often.
Yeah. Okay. And then you mentioned earlier that you're looking at re-entering Australia with a clean energy play. What can you tell us about that?
So we had a business here in Australia called Tilt Renewables that we grew actually out of Trustpower. And we sold that a couple of years ago because the valuations for those sorts of businesses had moved well beyond where listed markets were valuing them. I think when we started that sales process, that Tilt was valued at around $2 a share, and it was sold eventually for $8.05 a share, about 6 months later. So that difference of value was so compelling, we really had to access that for shareholders. But we also thought that at the time there would be a difficult period in Australia for development, and that within that period of time we could build another Tilt to address the market when we felt it was coming right. So this is very much the planned second step from selling that business. We have in Morrison & Co. and available to Infratil, the ex-CEO of Tilt Renewables, the ex-development officer of Tilt Renewables. So they obviously know a heck of a lot about developing here, and we have a lot of confidence in them, and they'll be involved in starting up that entity. It'll look a lot like Longroad or Galileo or these other platforms we've set up. Essentially, you give them a allocation of capital, which they can draw down for projects, and they go out literally driving around farms, those sorts of things, knocking on doors, finding projects that people have that they want to be developed, and we'll be bringing a reasonably scarce set of capability in Tilt and Dion and the team here. I'm happy to say in Melbourne, that's one of the things I was doing today. To help people get their projects to development. To me, that's the scarce resource in renewable energy. It's not money. It's not really solar panels or turbines. It's actually the skills and the capabilities needed to build these projects quickly and economically. And obviously, you had a good thing going with Tilt, and we hope to get it going again.
Yeah. Okay. Really interesting. I know Australia's talked about how it would like to be a sort of green energy exporter, maybe do some hydrogen. Would this project look to get involved in any of that, or is it just sort of electricity generation?
I think hydrogen is a really big theme, and personally, I do believe it will get traction. But really, it's just a matter of time. So in its future, there will definitely be hydrogen related to its projects. We see that already in Europe with some of our projects, not yet in the US, but I think it will get there. So I definitely think hydrogen. The export stuff, I doubt it. The issue with the export ones, or any of these really remote power production kind of facilities, is there's really only one place to sell your power, and that's quite a risk. So that's really for the big end of town who can carry either that risk or have relationships that enable them to deal with it. We'd much prefer to be in places where you have multiple ways to sell that power. It's a much lower risk. Better pricing usually too.
Okay, interesting. You mentioned the sale of Tilt. That left you with quite a lot of money, most of which you still have. If you do a little bit of math, you sort of have $1.4 billion of liquidity, and then potentially sort of another $600 million on the way from the sale of some Vodafone assets, which means you approximately have sort of $2 billion of firepower, of money sitting around to invest. That feels like quite a lot. How do you go about allocating that amount of money, and how quickly could you imagine getting that out into investments?
Yeah, no, it's a decent amount, and obviously that's what we do. It's our job, so it's not particularly daunting. But and the mass is a little different, I think, from what you said. That 1,400 we talked about included the tower proceeds. We are looking at selling our retirement village business, which would get you to the number you talked about. And we have actually, since selling Tilt, we've probably reinvested 500 or 600 million of those proceeds already into the new platform. Renewable energy platform in Asia. We bought a data center business in the UK. It's just that's been topped up by the tower proceeds recently. So, which is quite good, right? You're topping up with it. You're showing that you can deploy it, and I think really interesting ways. And the Australia platform will be one, but also you're getting more money in for your next set of ideas. We see plenty of opportunity within the three kind of main areas we focus on. And that's partly why Australia renewable platform with the next one off the cab. So that's going to take some of that capital, as I indicated. We think there are some really interesting new investment ideas in digital infrastructure. So, data centers, Vodafone is one of them. Other assets where you're connecting people through digital communication assets. There's a few of those things around where we think we might have a unique angle, a reason for bringing them into the portfolio, and we're talking about those probably as the next likely things off the rank. You have to kind of live in that, because maybe a year ago we were looking quite hard actually at some cancer care businesses that we had really strong belief in, and we thought fitted really nicely with our diagnostic imaging businesses, but somebody came and paid more than we were willing to pay for them. So we're always trying to remain disciplined, but also kind of share with you our thinking, so it's not a surprise when something turns up.
Yeah, that's interesting. I'm sure people on this call are investing on a much smaller scale than you, but doing a similar sort of thing. Do you have any golden rules for when you're thinking about investing in something? What do you think about, and how do you make sure you don't pay too much? Do you have any sort of little golden rules or good bits of advice you have? Not financial advice, obviously, just ways to think.
We all have different investment styles, I think. I think being patient is always really important, and for us, our purpose, as you sort of alluded to before, is to invest wisely in ideas that matter, and it's really the idea that drives where we want to allocate capital, and then drips down into what's available behind that idea and buy it. So we're constantly retesting ourselves on, does the idea hold? If we're fine with the idea, then we will be very patient and long term. You return to the idea rather than necessarily the business is kind of what guides us. So if we think the idea has changed, like for example in retirement, when we bought into that business, we thought that introducing the New Zealand version of retirement living into Australia would be very valuable, because they didn't have what Ryman and Somerset offer in terms of on-site, nearly hospital grade care. So that was the big idea. Actually, as things have evolved in Australia, it's moved away from that to more in-home care and things like that. So the idea has changed, and then we look at that and say, okay, do we think we've got something to offer there? Maybe not as much as we thought, and maybe we're better off focusing on diagnostic imaging, which is backed by another idea, right? So that would be my advice. Have the idea in your head and then be patient with it, but always constantly test yourself on the idea rather than what's going on day to day in your individual investment.
Yeah, that's really interesting advice. You sort of have a thesis. We think renewable energy is going to be big, and then you go and find something renewable energy to invest in, and then you just wait.
Stick with it, yeah.
Okay, that's good advice. It's interesting here you talk about Retire Australia. I speak to a lot of fund managers in New Zealand, and most of them love you, and you sort of ask what's your favourite thing in the portfolio. Lots of them will say Infratil. They're big fans, but they are candid people. And I did hear one talk the other day, and someone said, is there anything in the Infratil portfolio you don't like? And they said, and I sort of going to quote them as closely as I can, they said, I think if Infratil had a magic wand, they would wave it and not own Retire Australia.
Really?
Is that true? Do you wish you hadn't bought it, and are you going to sell it?
No, definitely not at all. Like actually, it's performed recently better than it ever has, and actually in terms of those pluses and minuses I mentioned at the start, Retire Australia was one of the big pluses that offset the diagnostic imaging businesses. So it doesn't worry me in the portfolio. I think if I was candid, I'd say we wish we'd executed better on our thesis there. We weren't as good as we hope to be in terms of rolling that model I talked about of care on site into existing villages. And probably what we might have underestimated is how difficult it is to retrofit that into existing villages. So we don't get everything right. We've had some other misses in the past. The trick is how you move on from them, right, and how you learn from them. And I think we've learned a lot from that, and we're happy to be candid where we miss. It is for sale. We do think, in general, we would prefer to focus our attention on diagnostic imaging, which we think has a longer runway ahead of it for us. But it's performing well. We don't have to give it away. There's no urgency to sell it at all. So, if it continued to perform it as it was and it stayed in the portfolio for a little longer, I think we'd all benefit from it.
Yeah. Okay. Cool. And not wanting to dwell on the misses, but I think it's a very interesting area to talk about because a lot of retail investors are probably sitting on some investments that are down a long way and trying to work out what to do about them. And as you say, like if the thesis is good, often patience is the way to go. But sometimes the thesis changes, or you have to decide what to do, and you guys did do that. You sold a business, Perth Energy, sort of at a loss in 2019. How do you think about that when something isn't performing? How do you know when to cut your losses and get out versus sort of waiting patiently forever as you lose more and more money? How do you cut losses?
So the thing that had changed in the thesis, the idea of investing in Western Australia was that it was on the verge of deregulation, and actually we invested in Victoria at pretty much the same time, based on the same idea. The difference was Victoria did deregulate its retail power markets, and Western Australia didn't. So we actually built a really great business in Victoria as a result of that made really good profits for Infratil shareholders, called Lumo, and we sold that. And then once we'd sold that, all we were left with was a pretty subscale business in a market where the idea hadn't played out. So it was kind of an orphan, if you like. And so that's what triggered the cut your losses. While it was within Lumo, it didn't matter too much. It was small. Maybe the idea would have proved out eventually and we would have earned the return we expected. But once we'd sold out of Lumo, the business in Victoria, it didn't make sense to run a small outpost out in Western Australia. Yeah.
Yeah. Okay, so that comes back to that same thing, is check the thesis holds. If the thesis holds, be patient. If the thesis doesn't hold, sell, even if it's a loss.
Yeah.
Okay, that's super helpful. There's an aspect of Infratil we haven't talked about, which is one of the bigger bits, the data center, data infrastructure, kind of the infrastructure of the internet. Talk a little bit about that, when you got into that, and whether you see it as being a growing market, if I need to ask that question.
Yeah, exactly. I mean, clearly it's pretty big. Even what we're doing today will be running through multiple data centers, right? So we got into that quite early, before data centers were really understood as infrastructure. It's one of those examples where we pushed the envelope, and people certainly raised their eyebrows at the time, said it wasn't infrastructure, it was a property play. But I don't think anybody argues about that anymore. So that was about 6 years ago. It has gone from, we invested $400 million when we bought that in conjunction with the pension scheme for Commonwealth federal government employees here in Australia. We invested $400 million then, and the latest sort of valuations are around three or so $billion. So it's been a phenomenally strong investment as well, one of the strongest we've ever had. It's driven by a lot of growth, and particularly through the pandemic, there are literally pallets of computers turning up to be put into these data centers to facilitate more or less what we're doing now. That growth, it's not quite early days of the pandemic stuff, but the outlook for growth in terms of generation of data, manipulation of data, and all those sorts of things is, more or less exponential. And that all has to live, be manipulated, and generally dealt with in a data center. So definitely that industry's growing. The thing you got to watch in that industry is competitors coming in, because everyone else can see this, right? And at the end of the day, it's a building with air conditioning at its very basic level of data center. What our data center business does is it specializes in a particular niche of data centers, which are designed for high security, sort of top secret clearance type applications. Mainly here, CDC Data Center stands for Canberra Data Centers, based targeted at federal government here. I mean, as it turns out, with the way the world's gone, focuses on security and cybersecurity in particular, that's crept out of federal government right into people who deal with federal government, the Googles and Microsofts and those of the world, but also now banks, big healthcare organizations, electricity networks. They all want that same product as well, and that's we're seeing sort of a double tailwind for that business of obviously data growth, but also growth in an area that Canberra Data Centres specialises in and has the best track record, of anyone at building those sorts of facilities.
Mm-hmm. I hadn't quite clocked that it's sort of a specialist high security data centre as opposed to just a regular data centre, and that's of course why it's called Canberra Data Centre and not Sydney Data Centre. Okay, yeah, that's really interesting.
Yeah, so it's in a special niche. That's quite helpful for us, I think, as more and more people enter the market.
Yeah, and how much of the Infratil portfolio is in data, or maybe you break it down, data and communications? Do you count Vodafone?
Yeah, over half bucket now, so nearly 60% is in, we call that digital infrastructure, but really it's CDC data centres and our stake in Vodafone. Mm-hmm. It's about 60-odd%, a quarter in renewable energy, as I said, roughly, and then, the rest in the health business, Retire Australia and Wellington Airport.
Yeah. Being invested in health, communications, and renewable energy, that's a feel-good portfolio, isn't it?
Should be ideas that matter. I think it ticks the box, but people can draw their own conclusions.
Of course. Vodafone recently sold its network towers, which is kind of a very classical infrastructure play. What's the rationale there? Why not hold on to that asset?
Yeah, to be honest, we're a bit torn. I mean, the infrastructure embedded in Vodafone was part of the reason we bought it. Step back a little bit, nobody thought integrated telecommunications companies like Vodafone or Spark were infrastructure companies. In fact, people with long memories will remember in the 2000s they were great places to lose money, not make money. But it became clear to us that there is an infrastructure embedded in these businesses that wasn't being valued in that way when we bought it. Probably base case, we wouldn't have sold it, wasn't in our original investment case. But what then happened since we bought it was the thinking around whether or not you needed to own this passive infrastructure, the towers, progressed from where it kind of used to be, I think in the around the 2000s, where you had an advantage in where your towers were, you should control them, it's a very strategic asset, to actually more of a situation where because of things like 5G, where you need to rely on many more base stations, which no telco has enough of to do itself. It became clear that you should be sharing a lot of infrastructure like that in a 5G world, and in order to facilitate that, actually having independent tower companies who could share their towers, freely with any of the providers who need it was the direction the industry needed to go to avoid having to build all these base stations or towers themselves. So there's a kind of a strategic reason from the telco end why this became more acceptable. And then the other thing that came along at the same time is certainly kind of pension funds and people like that who are looking for really long-term assets with long-term cash flows, like leases in this case, behind them, would pay really significant premiums for assets like that. So you had, on the one hand, telcos getting more comfortable freeing these assets up, to facilitate the sharing that kind of needs to happen. And then on the other hand, the weight of money for the type of those types of assets and the long-term lease you could put behind it getting higher and higher. So when we say we bought Vodafone, you can sort of value businesses on a multiple of their earnings. And telecommunications companies trade in the sort of 7 to 10 range. I think we paid around 7 times Vodafone's earnings when we bought it. For tower businesses, they were trading at around 30 times their earnings globally. Wow. So it didn't feel responsible really not to harness that when the gap between 7 and 30 had got so wide, and that's why we did the transaction.
Yeah. Okay, yeah. Sometimes, even if it's a good asset, if somebody's willing to pay such a good price for it, you can find another asset. Yeah. Okay, interesting. You have data centres in London doing a similar thing to CDC, but Business Desk reporting, it was actually written by my colleague, but included a line that caught my interest, which sort of said IFT has indicated its next major acquisition may be essential data play in one of the Five Eyes jurisdictions. Five Eyes being Canada, UK, US, Australia, New Zealand. One of the things that's sensitive in those countries is 5G. You own Vodafone. You've done communications. Are you looking at doing some 5G? What is being referred to there?
Yeah, I'm sort of being a bit cryptic because you always want to be careful. You want to be too clear to other people who are investing in these assets, what you're thinking of. But it was really a reflection. How can I explain this? I spent a bit of time in the US last month or the month before, and a very clear theme coming out of the people I talked to there was, with the tightening security situation around the world, and the tensions that are sort of emerged between the US and China, the competition between the two, there will be certain assets in Five Eyes countries that really only people from Five Eyes nations will be allowed to own. And it felt to me that was a really interesting thing for somebody from New Zealand. New Zealand is probably sort of the more neutral of all the Five Eyes countries, I guess, or certainly more independent. But also with our history in CDC, where we are a trusted partner of government in providing, security of a type that supports their ambitions and their role in Five Eyes, that's a real differentiator, I think, for Infratil and Morrison & Co. And an area where, in a world where everyone's competing for lots of assets and often you can get in fights where the lowest cost of capital, the most money wins. Actually, we should be concentrating on areas where we have a bit of an edge, and that's what I'm talking about. So I think there will be digital infrastructure assets where people with that sort of history, not only Five Eyes, but I think New Zealand being kind of independent, trying as long as it can, right, to be independent in its foreign policy, that we will be advantaged owners of, sought out partners, and that's where we'll be looking. I don't think it's necessarily in 5G in particular, but it could be. I think that is a really good example. 5G needs to be rolled out, and they'll want trusted people to be owning those networks.
That's a good explanation and good rationale. If you're looking for assets, and you can limit down the number of countries that can be competing on them.
Yeah, that's right.
Yeah. That's super interesting. It's funny, you think about investment as being a lot of looking at cash flows and doing math, but clearly you think a lot about geopolitics and societal directions. How do you stay informed on stuff like that? What keeps you up to date on things like geopolitics?
Yeah, I mean, I wouldn't profess to be an expert, but that is my nature. I mean, there'll be other people here. Morrison & Co. is 150, nearly 200 people, so people have different bents. That's certainly my bent. I'm definitely more, we call it top-down or strategy-focused. Probably got quite a strong people focus as well, as you might have heard from my explanation of what's important in renewable energy development. Other people will be more focused on that. That's really just my style or approach. And because, like all things in life, if it's an interest, you kind of do it for free, right? You do it in your spare time, and you read stuff you don't necessarily need to get paid to read. So yeah, I think it's just an interest of mine.
Yeah. It's interesting. I think when I first started getting into writing about markets, I was not that excited about it necessarily, because I thought it was all just it was all just dollars. But then I found that I was writing about the pandemic, and I was writing about geopolitics in Russia, and I think I actually find it super fascinating how often these numbers are just share prices or interest rates are just represented as a number, but there's so many human complicated feeds going into them. Yeah. It's super,
I mean, so much of it is about seeing the future, right, and predicting the future. That's a lot of what it's about, and it could be short term or long term. We tend to deal in long term because it's infrastructure, right, and so those sorts of societal things matter a lot when you're investing in assets that last for 100 years, right, like a hydro dam, or forever.
Yeah, it's a fascinating line of work. It was interesting, you mentioned earlier, talking about the stock market, that you wanted to sell Tilt because it was being valued at, you said, sort of $2 a share on the stock market, and someone was willing to pay $8 for it. This is something Infratil's pointed out a few times, that you sort of have a value written down on a piece of paper somewhere of what you think something's worth, and the stock market is giving it a much lower valuation. And this happened with Infratil itself. Infratil basically, Australian Super came along in 2020 and said, we want to buy the entire Infratil, everything you got, and we'll pay more than the stock market would. And Infratil actually sort of basically, the board of directors said, no, it's not enough money, even though it's quite a lot more than the stock market price. Why does that sort of thing happen? Why do you have assets that clearly are worth more than the stock market recognises? That gap seems to occur quite a bit. What's going on there?
The stock market tends to be driven by shorter term considerations than private markets, particularly infrastructure, which tends to be driven by much longer term considerations. So that is essentially what gives rise to the difference. So if, for example, interest rates are really high at the moment, certainly relative to the past, but I think most people believe that in the long term, interest rates will trend back to sort of new natural lows because of demographics, essentially. So a short-term listed investor will be taking into account the short-term interest rate signals and be valuing assets using a higher number. A long-term investor who's is thinking about pension liabilities, for example, they have in 30 years, they think much more about what's the average over the next 30 years, and that basically gives rise to a delta. The other thing that's happening a bit is the weight of money, so the amount of money sitting in those different worlds has changed, and the amount of money sitting in that very long-dated, future-looking pension fund world has got much bigger, and so they are just more influential, I think, on where values sit, just straight supply and demand.
Yeah. Okay, that's really interesting. Interesting to hear I don't know if it's something you can easily summarize, but what's your interest rate theory there, and that demographics going to force them lower in the long term? Is that something you can give an elevator pitch on?
Yeah, so a lot of growth around the world is driven by increasing population and working age population. That fuels GDP growth, which fuels an interest rate response. So faster growing countries will have higher interest rates in general. And when people look around the world, they see, generally in a lot of countries, aging type of population or shrinking populations, right? If you're in Italy or Japan or other places, even China now has that issue. So that
it does.
And so sort of in macroeconomics land at a very high simplified level, that should lead to a view of forward interest rates that are lower or trending down. At the moment we have inflation, which is why they're up higher. But in general, in Western economies, I think most people think, where they were obviously way too low during the pandemic, but before then, the sort of 2% to 3% range was a more natural range for it to be, given those underlying demographics.
Yeah. Okay, that's really interesting. Fast-growing economies, higher interest rates. Slow-growing economies, aging population, lower interest rates.
In a really generalised way, yeah, exactly. And that's most important for assets that last for a long time, which infrastructure tends to be. So that dominates the pricing of those assets. And private market investors can take that view. You can't really afford to take that view in listed markets just because of the way people are trading more and more often.
Yeah, it's funny, there are different definitions of long-term. People will say, I'm a long-term investor, I'm thinking about the 5-year timeline, and then another person will say, I'm thinking 30 years, I'm thinking 100. Yeah, it's different. We have had a question come through, Jason, so I'll throw that to you. They say, thanks for the great talk, clear rationale on digital and energy infrastructure. But with ever-increasing scarcity of natural resources, do you see Infratil investing in natural resource infrastructure? For example, water.
We do research water. And we've liked that as a theme. That's been one of the things we've been tracking for a long time. We just haven't found a way to invest in it that's attractive, particularly at home. We are looking actually, as Morrison & Co., at some water investments in the United States, because there's just more to buy. But you can't buy anything in New Zealand of any scale and any water, so it's never got off the ground here. But it's definitely a thing to watch. I think it is a really important scarce resource. Not just water you can drink, right, but also dealing with floods, all those sorts of infrastructure that'll be needed for managed retreats and resilience, I think, is a really interesting area as well. The world will need more of in the future, but again, there's nothing you can really invest in that space. So I'd categorise that as one that we're watching rather than we're close to investing in.
If a future government wanted to privatise water care, would you buy it?
I think we would be interested. I suspect the buyers for that sort of business, if you look globally for them, would have a lower return target than us. I think it's interesting, but I suspect we wouldn't be the highest value owner if people were looking to optimise what they sold it for. If they wanted a strong local partner, I think we'd have a really good shot. So it depends what they want to achieve.
Yeah. It's like, I don't think any political parties have that on the
I think we're pretty safe on that
yet.
one. Yeah, I agree.
Cool. Yeah. We're probably running up sort of at the edge of our time limit. Is there anything else you want to talk about, or any flags you want to fly?
No, not at all. Like, I appreciate the time, appreciate everybody's time, and thank you for the questions. They're, obviously very knowledgeable about the business, which is great. So, no, nothing to add.
Oh, it's a pleasure to get to talk to you, and great to hear a bit of your thoughts on how to invest, even if you and I are doing it in quite different number of zeros involved.
Yeah.
Okay, well, thank you everyone for tuning in, and thank you for Jason for joining us. If you are not following the podcast, you should do so. We're going to be back next Thursday, for another shared lunch. We're going to be joined by Ross Taylor, the CEO of Fletcher Building. Lots to talk about there, no doubt, so get your questions ready. A link to register for that discussion is in the chat right now. Please get involved, enjoy the rest of your week, and stay safe. We'll see you then.